Hello, I am Praveen Singh, research analyst at Mirae Asset Sharekhan. In today's video, we will discuss gold and silver ETFs and more importantly, how recent price corrections fit into the broader medium to long-term investment outlook for precious metals. Gold and silver outperformed all asset classes in 2025, yet in early 2026, following rallies to record highs, both metals witnessed sharp corrections. Let us take a closer look whether this correction changes the long-term story or whether it presents an opportunity. Current market snapshot. Silver touched a record high of $121.65 per ounce on January 29, 2026. Since then, prices corrected sharply, declining close to 50%. Silver currently trades near $78.6, up approximately 9% year to date. Gold followed a similar trajectory after reaching an all-time high of 5,595 per ounce. Gold declined around 25% from the peak. Current prices are near $4,810, up by 11% year to date. We see that volatility has increased. Why precious metals corrected? The recent correction in gold and silver has been driven primarily by certain macroeconomic factors rather than any deterioration in long-term fundamentals. Sharp rise in crude oil prices due to 39-day Iran war have reignited global inflation concerns. Consequently, expectations around interest rate cuts have changed materially. Just 7 weeks ago, markets were factoring in around 2 rate cuts by the US Federal Reserve in 2026. Today, expectations have dropped to almost zero. This shift is backed by data also. US CPI inflation rose 3.3% year on year in March, the highest in nearly 2 years. On a month-on-month basis, inflation rose 0.9%, the sharpest rise in almost 4 years. Secondly, a stronger US dollar and tighter liquidity conditions amid high oil prices have led to some sovereign gold selling, oblique swapping also. Thirdly, US employers added 178,000 jobs in March, far exceeding forecasts, while the unemployment rate edged lower. The data will alleviate the Fed's concerns about the job market to some extent. Collectively, these factors explain the near-term weakness in gold and silver. Gold outlook. Structural tailwinds remain intact. Gold's medium to long-term outlook remains firmly supported by strong structural factors. There is a continued global push towards de-dollarization as geopolitical friction and sanctions encourage countries to diversify away from the US dollar. Global sovereign debt has risen to unprecedented levels, estimated at around $340 trillion, reinforcing gold's role as a hedge against currency debasement or economic instability. Geopolitical risks also remain elevated, including trade wars and regional conflicts, which historically support safe haven demand for gold. Sustained high oil prices could eventually slow economic growth, which in turn may revive rate cut expectations. Slowdown in growth or recession will deteriorate debt GDP ratio further. Based on these factors, the outlook for gold in 2026 remains constructive, with prices expected to move towards the $6,000 to $6,500 range over time. So, use price dips to gradually build medium to long term exposure. Silver. From precious metal to strategic asset, silver is quite compelling from a structural perspective. Silver has entered its sixth consecutive year of global supply deficit. 2026 is likely to record a shortfall of around 47 million ounces. Powerful structural trends like exponential growth in solar photovoltaic installations, electric vehicles, defense, and AI-related hardware ecosystems will boost silver demand. Inventories are tightening rapidly. China's on-warrant silver inventory on the Shanghai Futures Exchange is at a nearly 14-year low, having declined 75% since February 2025. Similarly, COMEX-registered silver stocks are also at their lowest level since mid-2024. Policy developments are also supportive. The United States adding silver to its federal list of critical minerals in November 2025. China implemented export licensing for silver starting January 1st, 2026. Additionally, China's upcoming ban on sulfuric acid exports from May 1st is expected to impact copper production, indirectly tightening silver supply by 2 to 3%. So, huge corrections to build positions from medium to long term perspectives. Now let us briefly look at how investors are participating through ETFs. Among gold ETFs, market leaders include Nippon India Gold Bees, known for its liquidity, ICICI Prudential Gold ETF, which offers cost efficiency, and the Mirae Asset Gold ETF, which consistently maintains one of the lowest expense ratios, making it suitable for long-term investors. In silver ETFs, Nippon India Silver Bees stands out for its size and liquidity. HDFC Silver ETF is recognized for strong spot price tracking, and Mirae Asset Silver ETF remains attractive due to its low expense ratio. ETFs continue to provide a transparent and efficient way to gain exposure to gold and silver without challenges related to leverage or physical storage or purity. Displayed on your screen is a snapshot of select ETF offerings from Mirae Asset as of April 2026. This includes equity index ETFs, sectoral and thematic ETFs, factor-based strategies, and commodity ETFs such as gold and silver, allowing investors to construct diversified portfolios using a single platform. All our research offerings are now available in one portal, the Mirae Asset Sharekhan Research Center. Explore research calls and detailed research reports across equity, mutual funds, F&O, commodities, ETFs, and more. Visit research.sharekhan.com or scan the QR code to kickstart your wealth creation journey backed by our research experts. Thank you for watching.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.